In today's video, I want to talk about 5 ways that you can start to fix a broken or underperforming retirement portfolio. We've got a lot of ground to cover today, so let's jump right into it. The first mistake is having a portfolio disjointed from your needs in retirement. Said another way, the goals in your retirement plan should directly drive your allocation. It's become too common a practice to set your allocation inside of a plan based on something called risk tolerance. Go into most financial advisor offices, and typically they will give you a 10-question questionnaire on how risk-loving or risk-averse you are, and then match your investment portfolio accordingly. This is akin to going into a nutritionist and asking what foods you like, and then building your diet around that. Sure, preference matters to some extent, but we should start at what objectively is best for you first. This is often referred to as risk capacity. There are really 2 parts to risk capacity. What is the maximum amount of risk your plan can handle? But also on the other side, what is the minimum amount of growth and therefore risk your plan needs to meet your goals? When we look at data around safe withdrawal rates, we see that in both extremes, a retiree ends up in a worse spot. Too much safety in your portfolio, and you won't have enough growth to keep up with inflation and make sure your money can last long enough. On the other side, be too aggressive and you take too much risk and put yourself in a situation where sequence of return risk increases, and therefore so does your risk of running out of money. Part of the difficulty for some investors is that they've been full steam ahead during the accumulation phase and have been rewarded handsomely. 2 things matter in the accumulation phase: the savings rate and the growth rate. The higher the both of those are, typically the better spot you end up in. And so a strong saver who funnels 100% of their savings into a stock portfolio has done well historically. But retirement is different. When you're in the accumulation phase and the market drops, you have time to recover. Say your portfolio drops 50%. Well, you need to double your portfolio or make 100% to get back to break even. But in retirement, your withdrawals will deepen that drawdown. Say we are in a prolonged drawdown, and rather than being down 50%, your withdrawals further that to down 60%. Well, now based on compounding math, you need to make 150% to get back to break even. So matching safety to your withdrawal needs is paramount in minimizing sequence of return risk. Number 2, a common mistake I see too many investors make is just simply always jumping on the latest trend. They let popularity and the fear of missing out drive decisions in their portfolio. Remember ARK funds? They became extremely popular after COVID, as they seem to be doing incredibly well investing in future building companies. Tons of money poured into their funds during this time period based on, again, incredible performance. But as with most popular trends, everything came crashing down. If you invested before this popularity, as you sit here today, you're actually underwater on your investment. If you invested during the peak of the popularity, you are down big time. Bitcoin has been another popular trend that has jumped in and out of popularity inside of the news. In recent years, it's reached its peak of popularity according to Google Trends in early 2020 after seeing some significant appreciation. In most cases in investing, however, popularity should be a counter signal for investing rather than a signal. When we compare this to the price chart, you can see how following the most popular trend once again led to suboptimal decision making. Now, depending on your timing, money can certainly be made in hopping on the latest trend. But in my experience watching investors, more wealth is lost than is ever made by following trends. And psychologically, the ride is incredibly difficult. Another example was Tesla. Tesla once again had meteoric growth, and if you weren't investing in this groundbreaking company with an innovative CEO at the helm, you might have thought you were missing out on easy money. But it's been anything but easy money. Depending on your timing, you may be down on Tesla, or at the very least, probably underperforming a broad stock portfolio. Now, if you were early enough, you've done extremely well, just like if you were early enough on Bitcoin as well. But in both cases, it's probably been a little bit of a roller coaster ride, seeing your money double, triple, or even more, and then seeing it drop 60+% from its peak. Now, I'm not saying anything about the underlying investment here. There are positive things to say about Bitcoin, Tesla, or the popular stock of today, Nvidia. The broader point is that investing based on popularity rarely plays out as a good decision. Popularity typically follows incredible short-term performance. If you're investing after a ton of upside has already been realized, this by definition will carry more risk. In most cases, a meteoric rise is followed by a descent back to earth. Mistake number 3 is one that some may disagree with me on, but hear me out. I think most investors would be better served by avoiding ever investing in individual stocks. And I'll give you 5 reasons why. First, before you ever invest in an individual stock, Give me a thesis for why you are considering that given stock. Whatever your thesis is, there's likely an ETF or mutual fund that directly matches that thesis. Say you are investing based on a stock being a consistent dividend grower. Great, well there's an ETF that provides you with a basket of stocks, all of which are consistent dividend growers. This can give you a lot more diversification and save you a ton of time and energy. Want to invest in a sector that you think is poised for massive growth? Don't try to pick what you think is going to be the best performer in that sector. Just simply invest in the entire sector instead. And a big reason why you shouldn't try to pick singular winners is that the deck is massively stacked against you. It's extremely hard. Reams of data back this up. One of those data points is a report published by S&P Dow Jones Indices called the SPIVA Scorecard. This report compares actively managed funds to their benchmark. Now, keep in mind these funds are pouring millions of dollars into research as well as payroll to try to outperform the market and add value beyond their fee. Yet, we see that over the long term, 90% plus of funds underperform the benchmark. And this just isn't on a gross return basis, but also on a risk-adjusted return basis. Now I'm showing US equity fund stats, but it doesn't matter if we look at international funds, real estate funds, bond funds. Across the board, the vast majority of funds underperform their benchmark. Furthermore, stocks show power law characteristics. This means that a small share of stocks carry most of the outsized returns. For example, if you looked at the stock market from 1997 to 2017, you'd see that the S&P 500 grew 294%. More than 2/3 of stocks, however, within the S&P 500 underperform the S&P 500. So as an individual stock picker, the deck is stacked heavily against you. Reason number 3 that individual holdings are a bad idea. Most of the time, your individual stock holdings are redundant. Say you are investing in Apple outside of your other index funds. Well, just how much Apple exposure are you trying to achieve? Because when you look inside your index funds, you are already likely holding a ton of Apple stock. Apple is more than a 5% holding in many popular index funds because of how large and prominent of a company Apple is. And so before buying an individual stock, it's worth looking at how much you already own. This ties back into the trend investing point. At a time when Tesla became extremely popular, many retirees wanted to invest in Tesla individually, but already own Tesla elsewhere. Same thing with Nvidia right now. Number 4, I think individual stock investing forces a lot of needless complexity, and some of the most touted advantages of individual stocks are not really advantages at all. When investors have a portfolio of individual stock, the amount of decisions that are needed is immense. Say you have 50 stocks in your portfolio. How are you tracking all of those stocks? How are you deciding when to rebalance? Do you let your winners ride or do you take your gains off the table? A trend I see a lot with investors that have sizable taxable accounts is they will invest in individual stocks for tax loss harvesting benefits. Personally, I struggle to see where any benefit is realized. When tax loss harvesting, you are trying to capture a tax benefit without losing on performance. Sell something at a loss and you effectively get to deduct these losses against other gains or even your income, and then ideally reinvest and gain the performance benefits. Well, IRS wash sale rules make this very difficult. Say you invest in Microsoft and that stock is down. Now you decide to tax loss harvest it to capture some losses and gain those tax benefits. Well, the IRS won't just allow you to buy back into Microsoft immediately. They'll make you wait at least 30 days. So maybe you invest in Apple stock instead because, well, they're in similar industries and maybe should perform somewhat similarly. But after loss harvesting, Microsoft recovers from its losses, but let's say Apple remains unchanged. Well, now your tax loss harvesting just costs you far more than you could have ever gained. Using ETFs in tax loss harvesting is much simpler because you can invest in other ETFs that will match performance much more closely. It will be much easier to sell, let's say, a large cap growth fund from one company and then simply buy another large cap growth fund from another company, and you're going to find performance is much more similar. Then finally, investing in individual stocks forces you to be right twice. You need to make a good decision on the entry as well as on the exit. Timing is everything. Take that Tesla graph that we showed earlier. Timing differences around a few months can mean the difference between gaining substantially on Tesla stock or losing significant wealth. Yes, theoretically, timing matters with an index fund as well. But because you are investing in a basket of stocks, timing risk is greatly reduced. Portfolio mistake number 4 that we frequently see is something called portfolio sprawl. Anytime we meet with investors that have maybe a dozen accounts and sometimes 100 investments across those accounts, we like to start with asking, how did we get to this point? Typically that investor will ask with something along the lines of, I don't know, it really just kind of happened over time. This is the premise around portfolio sprawl. One of the first areas that we see sprawl is amongst accounts. Look, I understand that things happen in life. You change jobs, you start working with one advisor and then maybe move to another because you weren't satisfied with that first advisor. Maybe you open up a few accounts for this purpose or that. But we should try to eliminate needless complexity and, when we can, consolidate accounts down to their necessary parts. Every additional account you have leads to additional work of tracking, calculating exposures, and more. On the screen, I have a person's situation where they have 9 accounts, and in most cases, this could really be simplified to probably something like 4 accounts. Portfolio sprawl is even more common on the investment front. This is partially due to a mental bias called the endowment effect. Once we own something, we're more likely to retain that thing as opposed to divesting it. This means a bunch of little decisions can add up through time and create a mess of redundancy. Take the example on the screen. Say this was a group of stock positions inside of your IRA. There are 7 funds here, and within these funds, let's say hundreds of companies. This feels like a ton of diversification. The problem is, a lot of these funds are more or less the same thing. Most of these funds would be considered large cap growth funds, and therefore will carry significant redundancies. If you were to map out correlations across the board with these funds, performance correlations are well above 90% in all cases. Now, because we own a lot of funds, this gives us the feeling of diversification, but there's no actual diversification here. And this isn't just a phenomenon with stock funds. It's not uncommon for us to see investors hold multiple bond funds that are more or less the same, or multiple real estate funds that are all investing in the same things. Diversification isn't measured by the number of funds you hold, but rather the differentiation in those funds. Someone with one fund can theoretically have far more diversification than someone with 15 individual holdings or 15 funds even. Then the last area where I see most retirees needing big adjustments is in the realm of something we call asset location. Asset allocation is what you hold. Asset location is where you hold those investments. This matters because each account you invest in has different tax consequences. For instance, with a Roth, you pay taxes up front in order to never pay taxes again. All things being equal, we want this account to be our highest growing account because those extra gains will be tax-free. Then our tax-deferred accounts are tax-protected, meaning we could shift around investments theoretically every day and there would be no tax costs. We could receive dividends and there's no tax cost to those dividends. We are only taxed within our tax-deferred accounts when we actually withdraw from those accounts. There is also a dimension of forced income with these accounts through required minimum distributions. And so, all things being equal, we want to make sure we minimize those forced distributions, but we have some extra abilities to adjust investments around and receive extra income within those accounts without receiving an annual tax drag from it. Then finally, we have a taxable account, which I'll often refer to as a leaky bucket. The reason I call it a leaky bucket is because any income generated or gains realized within this account are taxable to you immediately. Given this, we want to make sure this account is as tax efficient as possible amongst your other accounts. We want to avoid that annual taxation because there's performance drag from it. Given this, here's a rough mapping that will fit most retirement situations. The asterisk here is that asset location is really plan dependent and can change this mapping quite a bit. For instance, if you are pulling from your Roth earlier in retirement to earn a healthcare subsidy, then you probably don't want as much growth within that Roth because obviously we need to pull from it and don't want to deal with sequence return risk. But in general, we want that Roth IRA to be growing at that highest rate relative to our other accounts. Jumping to the other side, we want your taxable account to have the lowest dividend yields, which typically means investing more in growth-oriented stocks. If we need to put bonds within this account, we often want to look at things like muni bonds, or if we're holding short-term bonds, we likely want to allocate those to a taxable account because of the lower yields on average. Then our higher yielding bonds like long-term bonds, high yield funds, and others should go directly inside of our tax-deferred account. REITs and value stocks should go here as well because of the high dividend rates. Allocating more bonds to your traditional accounts will also help minimize RMDs by slowing some of the growth within that account as well. Now, asset location is a big enough topic that we could devote an entire video to, and we have in the past. I'm actually going to link to some of those videos in the description below if you'd like to learn more rather than taking up more time in this video. But just how much of an impact can asset location have? According to separate research by Morningstar and Vanguard, asset location benefits can be as much as 35 basis points or 0.35% per year in after-tax return. Now that might not seem like much, but say we're investing $1 million over 30 years at an after-tax return rate of 6.5%. Well, that $1 million would grow to about 6.6 million. Raise your after-tax return by 0.35% per year, and now that $1 million grows another $700,000 up to 7.3 million. When talking about asset location, however, one of the biggest objections I often hear is around withdrawals. If we're holding safety in our traditional IRA, but we are trying to withdraw income or wealth from our taxable account, doesn't this throw the idea of asset location completely out the window? Well, I have a video right here that will show you a technique that we call relocation. This technique will allow you to basically take safety from your IRA and ultimately withdraw it from your taxable account. Click here to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching. We'll see you in the next video.